Gary, good to see you on the program. So the top 40, the all-share indices, they essentially were all in the red, falling by fairly large margins before recovering slightly, 1.16%, 1.19% lower for those two indices. Why exactly were these firms, NedBank, Sibanye Stillwater, Implats, why were they hit as hard as they were today?
Well, it's a good question. So looking at it, the South African market is very comprised of resource companies. Resource companies do tend to be what they call high beta. So what you do see is that generally when you get a market sell off, the resource index and specifically the resource companies will sell off more than the other companies. Part of this is the operating leverage within the businesses. If you look at it, the platinum price today was down around 5%. So to see a fall of around 5% in something like Impala Platinum is really not unexpected. If you look at Implats, also down significantly, although Implats has done a lot of work through its cost-cutting program, and this is kind of par for the course. NedBank, with the I suppose fears around global growth, the idea that interest rates are going to fall. And if they're falling in the US, they're probably going to fall in South Africa as well. I mean, we've got the first rate cut for the South African Reserve Bank at 0.25% penciled in for September, another one in November. This is going to impact bank earnings. We also have NedBank reporting tomorrow, so we're going to see the NedBank half-year numbers. And with I suppose the global sell-off and what we saw in the Nikkei this morning, I think a few traders may be taking a little bit of money off the table today.
Indeed. And just before we get into my next question, because I know there's some individuals who watch this and they've probably heard a lot of conversation around the carry trade today. Could you explain for the benefit of our non-financial viewers what exactly the carry trade is?
Well, the carry trade is essentially borrowing in a currency that doesn't require you to pay a high interest rate, where capital is essentially cheap, and then investing it in a country or commodity or at least or currency where you have a higher yield. And the idea there is that you can essentially earn risk-free profits. Of course, all of that is factored into the differential and the price movements of the currency as well. But in its simplest terms, borrow money in a low interest rate environment and invest it in a high interest rate environment.
And essentially Japan, the Japanese yen, was a favorite for this sort of thing because rates over there had been very, very low for a fairly long period of time until last week's rate hike by about 0.25%.
Absolutely. And I mean, looking at it, many people saying it was well telegraphed to the market that you should have been expecting, 0.25% increase from the Bank of Japan. But you got to remember that Japan has a debt to GDP ratio of 263%. So it's very difficult for traders to actually factor in something like a rate hike in Japan. And what you're seeing is a lot of that, essentially the escape valve, I don't know what you want to call it, the pressure that's being built up within their monetary policy being felt with a stronger currency. So it's coming through in let's say the US dollar Japanese yen pair. Looking at that, we were out at around 160 recently, and we've seen a massive improvement in the yen, down at around 142 today, although it has bounced up slightly from there. Part of that is also obviously that safe haven trade that you mentioned. As fears around a US recession, fears around global growth take hold, you do typically see things like the Japanese yen, the Swiss franc doing a little bit better. But really, for me, it was that rate hike that has just pushed the yen so much stronger, and that obviously in yen terms has taken a lot of shine off the underlying index, which is the Nikkei.
So a set of softer data, right? Jobs data from the US plus the Japanese rate hike last week. I mean, some would say that, look, this doesn't fully explain, right, 100% of the route that we're seeing, at least in this trading session at the moment. Are there any other factors, though, that might be prompting this general sell-off?
Well, it's difficult to put your finger on exactly why markets panic and why market participants panic. You could look at the escalation of tensions in the Middle East. You could look at a lot of things. But chatting to some of the traders that were around for the Black Monday, the 1987 crash, there was no real reason why markets crashed other than people decided that they were looking a little bit overvalued. And I think with the huge run-up that we've seen in anything linked to AI or technology stocks in the US specifically, there is definitely a sense that it's run a little bit too hard, a little bit too quickly. And when you're sitting on we were looking at it, an annualized return on the NASDAQ was sitting something at like 45% if it was to carry on going as it is. So when you're sitting on that kind of profit already for the year and you suddenly start to see the trade unwinding, it's very tempting to say, wait a minute, I'm well up for the year. Let me take some money off the table. And that almost becomes a self-fulfilling prophecy. And as people see it falling, they start panicking and exiting. And it's just market psychology. So yes, I don't think I agree with you 100%. The non-farm payroll numbers on Friday, just it wasn't weak enough. A lot of people now casting doubt on whether the Fed has been too slow to cut interest rates. I've seen calls for them to have an emergency rate cut of up to 75 basis points. If you look at Fed funds futures, we were pricing in about 0.25% cut about a month ago. We're now up to almost fully pricing in a 50 basis point cut in the September meeting. So this is too much of a move in the underlying expectations about rate cuts based on essentially 114,000 jobs being added instead of the expected 175,000. We were expecting unemployment to come in at 4.1%. It came in at 4.3%. We've seen misses like this in the past. So I agree with 100%. This does seem like a little bit of an overreaction. I think far more of it has to do just with the valuation of some of these high-flying tech stocks.
Indeed, and the comparison you make with 1987 is actually quite interesting, because comparing now to then, it's a hell of a lot easier for individuals like even you and I here in Africa to trade in those specific markets, and we have access to a lot more interesting automated trading strategies. We can, put in stop loss orders, stop limit orders, and so on to essentially try and limit the downside risk. But at some point, these sort of feed into some sort of feedback loop, a sort of doom loop, if you will, that essentially makes these sort of market declines a lot faster. Is that also a factor here?
Well, I think it does make the market declines a lot faster. So if you look at, I suppose, the developed markets versus the emerging markets, developed markets, I've seen up to 70, I've seen estimates up to 75% of all trades are algorithmically driven. In emerging markets, a little bit less. You're looking at probably 40 to 45%. But when you look at it, you would assume that it does accelerate things, because as markets fall, if you've got a stop loss order, as you've said, that's going to trigger automatically if you have a margin call. I remember when I first became involved in markets, margin calls weren't an automated thing, and you would have to essentially phone clients and tell them you now have a margin call, please either top up or close your positions. These days, it's all algorithmically driven by the systems. If a geared position moves into a margin call position, it's automatically unloaded to protect the institution. And that obviously can exacerbate things. That said, if I look at the range of algorithms that are out there these days, I mean, just the algorithms that we have when we're executing for portfolios, from icebergs to VWAP algorithms to a whole swath of different things. Algorithms can be programmed away, automatic trading strategies can be programmed in a way that essentially adds stability to the market. So it's very, very difficult to say that just because of the automated nature of trading these days, this is exacerbating the sell-off, because there are plenty of algorithms that see prices move down and then move into buy in the market as well. So I still think a lot of the direction of the market has to do with human sentiment. Behind these algorithms are still traders that are still making decisions. There's still investors that are trying to maximize the returns for their portfolios. And it's not just a computer program running amok, if you want to put it that way.
Indeed. I'm sure there will be some comparisons with the flash crash from around 2010, but we can have that conversation at another time. I'm Gary Booysen, Portfolio Manager at Rand Swiss, joining us there from Joburg. Thank you very much.